Another day, another MSTR or strategy income oriented ETF has just been announced by Roundhill. So, Roundhill Investments, the same people who do QDTE and XDTE, have this series called their weekly pay series. And they just announced, they announced it on July 18th. They said that the wait is over to Roundhill MSTR weekly pay ETF. MSTW, that's going to be the stock symbol, is launching next week. So by the time this video comes out, it could probably be out already. But as of now on their website, as I'm filming this, it's not there yet. So what is this ETF? How does it work? Because it's actually not a covered call strategy, but it's still very interesting. So their weekly pay ETFs, obviously they're going to pay weekly. That's a given. They do have enhanced exposure. They do have leverage, but it's 120% leverage. So it's only 20% or 1.2x leverage, which is actually very modest, very low. We know in Canada, they have those 25% leverage ETFs, cover call, and 25% leverage ETFs that I love. And that's what I invest in. So 20% a little bit lower. And it's not your typical leverage in the US where it resets daily, which is more designed for traders. It's very more volatile. This is actually reset weekly. So this is 1.2x leverage reset weekly. So it's a little bit, it's not as drastic, or I would say a little bit more conservative than the daily reset. And it's only 20%. So what is the point? Well, it's designed. What is the point of these ETFs? Because they have a few of them. We're going to take a look at the performance of some of them, by the way, because they've been out. Some of them have been out since February of this year. So we do have some sort of data. So how do they work? Because they have no cover calls. Well, it's designed for investors seeking weekly income and amplified exposure to single stocks. First of its kind ETFs aim to provide weekly distribution and enhanced returns equal to 120% of a given stock's calendar week price return before fees and expenses. So for example, if we just look at the Apple one, the first thing I noticed, and we're going to take a look at just a few of them, because this is going to give us an indication on how the MSTW Roundhill weekly pay ETF is going to behave. Right? So first of all, the yields are very high. So if you look at the Apple one right now, 57%, 58% on the Tesla, which I feel, why is Tesla about the same as Apple? And we're going to take a look at that in a second. Palantir, 75%, Coinbase, 81%. So these are very, very high yields. But something you need to take into account is, just like the QDTE and XDT, the monthly distributions are going to vary drastically. I mean, you literally have 39 cents, 75 cents, maybe that really high distribution on Apple is probably based on the 75-cent one, 22 cents, 26, 14, 10. So all of them have very, very different weekly distributions. So if you're looking for consistency with your weekly distributions, these are definitely not the ones to consider. But the $1,000,000 question, if you're not doing covered calls, if these are just leverage ETFs that only hold one stock, 20% leverage, reset weekly, how are they deciding how much to give out every week? Where is that coming from? Well, they're not getting any call premiums because they're not doing any call options. And you could see that right here in the FAQ. So the key information is in the FAQ. Unfortunately, I cannot have the CEO of Roundhill back on the channel. Last I spoke to him, he said that his compliance team has forbid him to go on any YouTube channels. I don't know if that's still the case, but unfortunately, Dave cannot come on the channel. So we're going to have to try to figure it out for ourselves. So first of all the funds have, all these weekly pays seem to have a 99 MER, which is in line with the YieldMax and other competitors as well. So pretty high MER, I would say. So it's actively managed. It pays weekly. Do they sell options? Do they sell call options? No, they don't sell options. They offer uncapped, right? There's no upside cap because you're not selling covered calls. Leveraged upside to their underlying reference asset. So here's the $1,000,000 question. How are the weekly distributions determined for these ETFs? The weekly distributions are calculated each week based on a proprietary formula that incorporates the reference assets performance and implied volatility. So my guess here is that if the stock is having a good, really, really good week, most likely the distribution is going to be higher. If it's not having a good week, it's going to be lower. So they're basically they're holding a leveraged exposure to Apple stock or Tesla stock or Palantir stock, blah, 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 blah. And they're deciding every month just to give out a certain percentage of the fund's NAV. So think of it like owning Apple stock or Tesla stock, or of course MSTR stock when MSTW comes out, with a little bit of leverage, reset weekly, and they're kind of selling some of those shares every week, so you don't have to do it for you when they're deciding how much to sell and to how much to give out. There's a little bit of leverage. That's the advantage, right? You don't have to manage the leverage yourself. So they're not cover call. They're definitely income oriented, and they're deciding for you every week how much to give you. So that's why the weekly distributions are very erratic. So we do have some data. How does the Apple one compare to just the Apple stock? Tesla. We're going to look at 4 of them, 2 stocks that have done really, really well, Palantir and Coinbase, and 2 stocks that have been a little bit flat February till now. So let's look at the 2 flat ones, which is Apple, Tesla. So Apple versus the weekly pay Apple. Let's look at the total return to performance. You see that Apple stock, or the weekly pay Roundhill one, is underperforming by quite a bit. It's minus 17%. This is as of February. So we don't have a lot of data, but this is just like February, March, April, May, June. This is like 4 months, guys. It's not that long, but you see that obviously if the stock is on a downward trend or a little bit flat, like Apple has been, the leverage will really hurt you. You see that in blue is the Roundhill one, and you see that when there is a downtrend, the blue will go down more, right? That's just what the leverage does. So Apple underperforming, not very impressive, to be honest. And that's even with distributions reinvested. Most people are getting these not to reinvest the distributions, but to spend the money. If you're doing that, your return is actually even a little bit lower. You're at minus 17.49, whereas if you're reinvesting, you're at minus 17.11. What about Tesla? Tesla's the same type of story. So the Tesla one, it's been up and down lately. When this came out, Tesla had a big drop, and you actually see obviously the one in blue, which is the weekly pay, is going to drop more because it's leverage. It's 20% leverage. So you see also the Tesla greatly underperformed, minus 13.98, whereas just the stock is at minus 7.89. Even a little bit more pronounced if you're not reinvesting the dividends. But what about stocks that have done pretty well in this period of time, like Palantir and Coinbase? Well, if you do the Palantir one, you see the trend is an uptrend, really, and you see that it's pretty much on par. The performance is pretty much on par, the Roundhill one, with just holding Palantir. But only if you're reinvesting the distributions. If you're not, you're still underperforming greatly. Which is quite telling. And last but not least, we'll just do Coinbase real quick here. The Coinbase one, same type of story. The stock has done really, really well. You see that the performance is actually better. This is the first one where we have a better performance, but not that significantly, just barely, everyone. And again, if you don't reinvest the dividends, you are underperforming. So the performance, to be honest, in my opinion, guys, if you're trying to decide whether you're going to swap your MSTY, your MSII, or not, that there's a bunch of other ones. There's one from Bitwise. There's other ones as well for MSTW. Well, in my personal opinion, after looking at the data of how 2 really good stocks have performed and how 2 flat to not so good stocks have performed, it's not that impressive to me, to be honest with you. I would prefer, I think, a cover call strategy would work better. Obviously, it's not much data. It's 4 months of data. And obviously, if the stock is doing really, really, really well, it helps a lot, like Coinbase and Palantir. But even so, it's not that impressive, and the returns are only decent if you're reinvesting the dividend. So in my opinion, I think this one, I think the cover call strategy ones are better, in my personal opinion. The ones I like the most, the ones I'm most attracted to, is MSII. And by the way, everyone, I do have quite a few videos on these strategy cover call ETFs, including this one here, which is one of my top videos of all time, with over 250,000 views, where I talk about MSTY. But in this one here that came out a month ago, I do a deep dive into the MSII versus MSTY. So I'm not going to really get into in this video, but if you're interested, I would highly recommend checking out this video. But in my opinion, if you're an income investor, you're going to buy and hold a long time. I think you're better off with a cover call strategy instead of these weekly pays here from Defiance, because you don't really know exactly what that proprietary algorithm is, how much they're giving out, and it could vary greatly. And the numbers speak for themselves. The strategy is, in my opinion, not working that spectacularly for the ones that are existing, especially if the stock is on a sideways or downtrend, where obviously a cover call strategy would probably outperform, especially MSTY, because it has no leverage. So I think MSII and MSTY are still the two top ones to consider if you're an income investor. Personally, you guys know that I love not as little cover call as possible, but with a little bit of leverage. I'd rather have the leverage to boost the yield a little bit instead of writing more covered calls, because if you're bullish on something, especially like me, and I'm bullish on MSTR, like many of you watching, but you're an income investor, you actually want the least amount of covered calls. And YieldMax is not called YieldMax for a reason. They're writing a lot of covered calls, so you're giving up a lot of upside if MSTR does well over time. So I'm not saying it's a bad choice. I think it's one of the two top choices that you have, the American stock market. If you're just looking for maximum yield, right? Let's say you're a Bitcoiner, you own you own a bunch of Bitcoin, but you need fiat to pay your bills. MSTY is a good option. You get monthly, very, very high monthly income. But personally, I'm a little bit more attracted to MSII, and it's actually called growth and income. They're actually writing covered calls on only half of the portfolio, where here they're writing covered calls on the whole portfolio. And there's a little bit of leverage. The leverage here is between 105% and 150% daily. So it is a little bit more leverage. It's definitely more leverage in the weekly pays, but I really like the fact that they're doing the cover calls on half the portfolio. Also, it's weekly income. The yield is very, very high. You could check out the weekly dividends here. There's going to be variance as well, but the yield is very high. If we just calculate the yield based on 26 cents on the last distribution, right? If we do 26 cents times 52 divided by the current stock price here, NAV, the yield is about 50%. So it's still very, very high, but it's not going to be as high as MSTY most likely, because they're covering half the portfolio. But that leverage helps to get the yield up. So in case you're wondering, is MSII beating MSTY? Well, it's only been out for a little while, guys. It's barely been 2 months, but so far, yes, it is outperforming MSTY. You see that the outperformance is especially shown, and especially I'm thinking of a word here that obviously I'm forgetting the English language. The outperformance is appearing very much when there's an uptrend, and that's because of the leverage and the least amount of covered calls, right? Less covered calls plus leverage, you'll get more upside if MSTR is going up like crazy during this time frame. But the opposite is true when there's a flatter down. You see, when there is a downtrend, of course, MSTY is going to outperform. You see that MSII goes down a little bit harder. So this, to me, MSII really is behaving to me similarly like the one that I prefer in Canada, MSTE. So MSTE is the Harvest MicroStrategy Enhanced High Income Shares. Unfortunately, if you're American watching this is listed on the Canadian stock market. So most likely you're not going to be able to invest in it either, because you're not going to see it when you're looking for it. Plus, you're going to have to convert your USD to Canadian dollars. Plus, you're going to have to probably deal with withholding taxes. So it's probably not worth it. But the closest thing to MSII is basically MSTE. And what Harvest does is they do covered calls on typically only 33% of the portfolio. They could go up to 50, but the CEO told me that they're very comfortable going about the 33% range, which means 66% of the portfolio is uncapped, and there's also 25% leverage. But unlike the leverage that you typically see in the US, this is classic leverage. You're literally borrowing the money, 25% of the fund, 25% leverage, so it would be slightly higher than this one and slightly lower than MSII. It would be 1.25x. This is the one I own personally. Covered calls, 25% leverage, and a very, very low management fee of 40. MER, right? 40 basis points. The MER is going to be much higher, by the way, because it's going to include the leverage cost because they're actually borrowing the money, and that has to do with the interest rate as well. So there you have it, guys. I hope this was informative for you if you're thinking about, well, you know, should I include this one? Well, listen, I mean, it could do well over time if MSTR does well over time, but the proof is in the pudding, even with Palantir and Coinbase that have done really well. Performance is really not that stellar, and you have to reinvest your income, or else the performance is going to be much, much lower. So I think just sticking with a cover call strategy, MSII or MSTY is the way to go if you're looking for income off of MSTR. There is MST, by the way. Again, I discussed it in detail in this video where I do the comparison. But this one is really, in my opinion, a little bit too leveraged, too dangerous, and is more designed for traders, not really long-term investors, buy and hold investors. But again, make sure to check out these videos where I go do a deep dive, including this one where I actually interview Sylvia, where we talk about MST in detail. And again, guys, there's no right or wrong here. It's up to you to figure out which MSTR income ETF is right for your portfolio. And by the way, don't forget, everyone, that you could always mix and match. There's nothing wrong with that. So give me a thumbs up. I would really appreciate it. Do you like this type of video? Let me know your comments in the comment section below, and see you next time.